Derivatives, as the name suggests, derives value out of underlying assets. These are just a contract and have no value of its own. The most common assets for which derivative contracts are made are stocks, bonds, foreign exchange, commodities, crude oil, and indices, etc. The main types of derivatives are futures, forwards, options, swaps. The seller gets into a contract to sell 1 ton of aluminum for $2,000 in 2 months' time. The buyer and seller have fixed their buying and selling prices. Futures are a form of derivative in which two parties enter into a contract for sale or purchase of an asset on a future date at a fixed price. The time for the execution is generally a pre-specified period in future. The future date is called the delivery date or final settlement date. The reason behind getting into a future contract is not to acquire an asset but to hedge against price fluctuations. To hedge against price fluctuation basically means to protect an individual from the loss incurred due to the price change of the asset. Forwards are very similar to futures. They are a contract to buy or sell asset on a future date at a fixed price. Futures are highly standardized, while forward is unique. Futures are settled at the settlement price fixed on the last trading day, while forwards are settled at the forward price agreed on the day the contract was made. Future contract is delivered to person chosen by the exchange, while forward contract specifies whom to make delivery. Options is a type of derivative that has a contract that gives one of the parties the right, but not the obligation, to exercise some feature of the contract. The amount the buyer pays to the seller is called option premium. On non-execution of the contract, the buyer loses the option premium paid by him. Swaps is another kind of derivative, in which two parties enters in a contract to exchange one stream of cash flow for another. The cash streams that are swapped are called legs of the swap. If party X wants to get out of a swap contract, he can do so only after mutual agreement with the counterparty, or by selling his rights to a third party, with the consent of the counterparty. Swaps can be used to hedge certain risks such as interest rate risk, or to speculate on changes in the underlying prices.